Hello everyone, Brittany Elliott here, and today we are diving into a strategy that can be a game changer for your financial future. It's called the Backdoor Roth IRA contribution. Now, whether you're a seasoned investor or just starting out, this technique can be a game changer in your retirement savings. So stick with me as we walk through the process step by step. We're going to break down what a Backdoor Roth IRA is, why it's beneficial, and how you can make it work for you. But before we get started, go ahead, hit the subscribe button, turn on the bell notifications so that you don't miss out on any future videos. All right, before we get started, let's make sure that we're all on the same page. What is a Roth IRA? A Roth IRA is a fantastic retirement account in which you make after-tax, non-deductible contributions to the Roth IRA. They grow tax deferred, and then your withdrawals qualified in retirement are tax-free. This means that all of the growth that you make on that money is completely tax-free money. However, not everyone can contribute directly to a Roth IRA due to income limits that prohibit higher income earners from contributing directly to the account. That's where the backdoor comes in. Now, make sure you stick with me to the very end here because there are some important tax considerations to keep in mind, especially if you already have funds in an existing traditional IRA. So let's get started. The backdoor part refers to a two-step process in which you first contribute money to a traditional IRA, non-deductible after-tax contribution, and then you turn around and convert that contribution amount from the traditional IRA into the Roth IRA. It is, of course, more complex than simply making a contribution directly to a Roth IRA, but for those who are not eligible to do so, these extra few steps are absolutely worth it. Remember, we're getting money into an account that will grow tax-free, not just tax-deferred, tax-free. So the extra effort is worth it. All right, let's get into the steps for how to make those backdoor Roth IRA contributions. Step one, check your eligibility. First things first, determine whether or not you're eligible to contribute directly to a Roth IRA. As I mentioned before, these income limits can change from year to year. So you'll want to consult either with your tax professional or the IRS's website on irs.gov to find out what the maximum income limits are. You can use your previous year's tax return as a starting point for estimating your income for this current year, but remember to account for any increases or decreases. Maybe you got a raise, maybe you got a bonus, maybe you took some time off. So just remember to keep all of that in mind when calculating your income. If your income falls right around the limit amounts, like you're hovering right around that threshold, it may be best to wait until the following year to make the contribution. This way you can know exactly what your income was for the year before making the contribution. You have up until April 15th, 2024 to make an IRA contribution for tax year 2023. So if your income makes it where you are eligible to contribute directly to the Roth IRA, just do that. Don't do these extra steps if you don't have to. But if your income is over it, follow along for the next step in order to make these contributions. Okay, step two is to contribute to the traditional IRA. Open a traditional IRA if you don't already have one and make the maximum allowed contribution for the tax year. This can change every year, so you'll always want to consult with the IRS's website, a Google search, or your tax professional. For tax year 2023, the maximum amount that you can contribute is $6,500 if you're under age 50 or $7,500 if you're age 50 or over. Again, these amounts change from year to year, and you do have to have earned income in order to qualify. This contribution that you're making to the traditional IRA will be referred to as a non-deductible contribution or an after-tax contribution. This means that you will not be deducting this amount on your tax return because you do not qualify to do so. Step number three is to wait for settlement. After contributing the funds to the traditional IRA, you'll need to wait for the funds to settle. This usually takes anywhere from a couple of days to a week. I also recommend not investing the funds inside the traditional IRA because that's going to make the whole process a lot faster and simpler from a tax perspective also, as there should be minimal to no gains on the amount if you just leave it sitting in a cash account. Step number four is to convert the funds to the Roth IRA. So you will transfer the funds from the traditional IRA to the Roth IRA as a conversion. This means that any growth that has happened on that amount will be taxable to you. But since you're doing this in a relatively short period of time, and as long as you don't invest the funds, like I mentioned before, there should be little to no increase in the balance if it was just left in a cash account. Once the funds are inside the Roth IRA, however, you'll want to make sure that you invest them as soon as possible so that they can begin growing. Now, step number 5 is to report the contribution and the conversion on your tax returns. Pay close attention to here, as it can seem a little tricky depending on a few factors when it comes to your taxes. When you file your taxes, you'll need to report both the contribution and the conversion on IRS Form 8606. This form helps keep track of the basis in your IRAs and ensures you don't get taxed on the same money twice. The contribution is being reported on Form 8606 instead of on your 1040 because you're not deducting this contribution. There would be no point in deducting the contribution even if you were eligible to, because if you deduct the contribution on your taxes, then the full amount that's converted over is considered taxable income, and you're going to pay the taxes then. So really, they would just cancel each other out. So there's no point in doing the extra steps. An important note here, if you're making the contribution in the following year for the previous tax year, you're going to need to make sure that you report the contribution for the tax year for which it was made for, and the conversion is going to get reported in the tax year that it occurred in. So for example, if you make a contribution in February of 2024 for tax year 2023, and then convert that over to the Roth IRA, you're going to need to report the contribution on your 2023 tax return, and then the conversion will not be reported until you do your 2024 tax return. The conversion is always going to be reported for the tax year that it actually occurs in, regardless of what tax year you made the original contribution for. Your traditional IRA custodian, which is the financial institution that's holding your actual traditional IRA account, will send you a Form 1099-R near the beginning of each year, and that will show any amounts that were withdrawn from the traditional IRA for that year. So that is where the conversion will show up. This information will also be reported to the IRS. You will also receive 2 Form 5498 later in the year, usually around May. These will show the contribution into the traditional IRA, and then it will also show the conversion going into the Roth IRA. These forms will not be received until after your tax filing deadline, so you'll need to make sure that you report the accurate information on your actual tax return, in which case you need to keep good records of how much you've contributed, how much you converted, and then you can also verify all of this on your statements or through logging into your account online. Now, before you rush to begin implementing the Backdoor Roth IRA strategy, there are a few things to consider, one of which being existing traditional IRAs. If you already have a traditional IRA with pre-tax funds in it, then the pro rata rule can complicate things a bit. It's very important that you consult with your tax professional before proceeding with this to ensure that you have everything documented correctly and that this does make sense for you to do. In the steps we just went over, we made a non-deductible contribution to the traditional IRA, and then we converted it over to the Roth. We didn't deduct the contribution on our tax return, therefore the funds in the traditional IRA were considered after-tax contributions. The pro rata rule applies if your traditional IRA consists of both pre-tax and after-tax funds, which may very likely be the case if you've already have an existing traditional IRA balance, either through contributions or from rolling over a 401k from an old job, for example. The pro rata rule is used to determine what percentage of the withdrawals are taxable versus not taxable. You're not able to choose only the after-tax funds when you make a withdrawal out of the account, and doing a conversion is taking a withdrawal out of the account. Okay, let's look at an example for this. If you have a traditional IRA with a balance of $20,000 that is all pre-tax money, meaning you deducted the contributions when you made them, or they were from a rollover from a 401k that was all pre-tax money. Then let's say you make a $5,000 contribution to the IRA this year as a non-deductible post-tax contribution, and you want to convert the $5,000 over to a Roth IRA. You will not be able to convert the entire $5,000 as tax-free because a portion of it is going to be considered pre-tax. So you had $20,000 of pre-tax money in the traditional IRA, and then you added $5,000 of post-tax money, bringing the balance up to $25,000. Of this $25,000, 80% is pre-tax, $20,000, and 20% is post-tax, the $5,000. With the pro rata rule then, if you convert $5,000 over to the Roth IRA, 80% of that amount will be treated as pre-tax, and therefore will be subject to taxes in the year that you make the conversion. So you would have to pay income taxes on $4,000 of the $5,000 conversion. Even though the $5,000 contribution you just made was all after-tax dollars, $4,000 of the conversion is getting treated as pre-tax dollars. Opening a new traditional IRA to use only for the post-tax contributions will not help to avoid this, because the pro rata rule applies collectively to all of your IRA accounts, no matter how many you have. Now, there is a possible workaround for the situation if you have pre-tax funds in a traditional IRA. If you have a 401k plan that will allow you to roll traditional IRA funds into the plan, you could first roll your entire traditional IRA balance into the 401k, thereby leaving you with a zero traditional IRA balance, and then start doing the backdoor Roth contributions. This is a much more complex strategy that may or may not be suitable for your situation, so be sure that you consult with your financial advisor and your tax professional before proceeding with doing this. And there you have it, the scoop on backdoor Roth IRA contributions. It's an advanced strategy that can be incredibly beneficial for growing your retirement nest egg while minimizing future tax burdens. But remember, everyone's financial situation is different and unique, so it's crucial that you consult with a financial professional prior to making any major decisions on your finances. If you found this video helpful, please remember to click the like button because that will help it reach more people. Also, subscribe to my channel so that you don't miss out on future videos as they come out. Also, if you have any questions or any comments you want to share, please feel free to drop them in the comments below. I'd love to hear from you, and I'd love to answer your questions. As always, thank you for watching, and I will catch you in the next video.